Hello, Vetted VA community. It is March 23rd, 2023. I, of course, am Helmer, your resident mortgage rate expert, your mortgage market guy. And today I'm joined with our guest, Carlos Scarpero. Carlos is a Vetted VA vetted member. And Carlos, please tell everybody a little bit about yourself.
Sure. I've been part of Vetted VA for 2.5 years now. Been mortgage industry on and off for 20 years, although it took quite a long break to do some online marketing side hustle businesses. And yeah, I've been very passionate about the VA program. I'm here in Dayton, Ohio area, and we got Wright Pat Air Force Base, of course, near us. So that's been just a great, wonderful community to work with. And so, Hammer, I'm just grateful to be on the call and share my insights as we go through this.
Awesome. Well, thanks for joining us today. Remember, everybody, if
Absolutely.
You guys are here, go ahead and pop us with some questions or comments. If you're here live, let us know. Let's see. I already see a comment. We got Rocky on this today. I said this morning. It's 12 o'clock for me, but what's up, Rocky? If you are here as well, I see a bunch of you are on. You could be. I see a couple from the Vetted VA professional community. I see somebody from our Vetted VA community on Facebook. So go ahead and say hello. Let us know that you're here. Share with us your name. Let us know if you're a consumer or professional. If you are watching on the replay, I know many of you do watch on the replay. Same thing. Let us know that you were here. Chime up in the comments. Drop your name. Let us know that you watched. And if you're watching on the replay, give us a hashtag replay. Let us know that you are watching. So, well, Carlos, let's jump in. I want to just remind everybody of kind of what we did last week and what we said last week. And then we'll talk about where rates are at and where rates are going. Today, of course, being a big day with the Fed meetings. So jump over a few slides. Let's go back. All right. So last week, I had said that rates were likely to be volatile, meaning that they would bounce around depending on the moods of the markets. It doesn't get more vague than that, but that was kind of, we were watching to see where things went. We've talked about this banking crisis. I've shared with everybody that I think it's about as much of a crisis as a cereal crisis, that we're going to run out of cereal. I think our banking system failing is about as likely as us running out of sugared cereal in the United States. So the events that convince the markets that the Fed is done raising rates will help mortgage rates. And what were some of those events? Mainly that was the banking situations where certain banks were failing, et cetera. And we said that next week's Fed meeting will either send rates soaring or plummeting, and that we would talk about that more this week. So, let's see if what we said was kind of where things went. So what actually happened over the last week? Rates did bounce around. I know that I saw that rates generally for VA rates, they were in the low to the mid sixes, would go down as low as 6 or 6.125%, then push up to 6.25 or 6.375. And then conventional rates were in the mid to high sixes. So I saw a lot of conventional rates that were generally about 6.5, pushing up to 6.25. Again, these are generalities when we talk about the rates. And, this is for a conventional, home buyer for a primary residence, just to give you guys ideas of kind of what we saw. Carlos, is that what you saw as well? Or what did you see over the last week with the markets and rates?
Oh, yeah, rates have been going down for sure. And happy to see improvements. I've been calling people, locking people in. Good stuff.
Yeah. All right, so let's kind of give everybody a little bit of a forecast. What do we think is going to happen? This one's kind of wishy-washy, y'all. It depends on how today plays out, and we're going to talk a lot about that today. Today we have some big events. It is the day of the Fed. Instead of the Day of the Dead, it is the Day of the Fed. Today we have the Fed meeting, and it is the Federal Open Market Committee meeting. Happens about every 6 weeks. This one taking on some more importance than even a normal meeting. Every Fed meeting is an important meeting, but this one's even more important. Carlos, do you have any insight about why this meeting is so important, or have you been following along with what's going on with the banking situation and how the Fed might act?
I have been following along. I mean, it's kind of crazy with that bank failure of the Silicon Valley Bank last week, and people wondering, okay, are the rate increases going to make it worse? And I know there's some controversy of, was the failure of Silicon Valley Bank because of the rate increases, or was it because they just had bad investments? And it seems like the rate increases did have some effect on that. And so certainly if the rates keep going up, it could cause more bank failures. So then the Fed's kind of a pickle. Like, what do they do? And so, yeah, it'll be interesting to see what they do. So, Helmer, should we be locking or floating right now? I mean,
well, and that's
it's too early to know.
It's definitely too early to know. So for consumers, you can only lock in a loan when you have a mortgage application in and you found a property. So unfortunately, there's not many programs out there that will let you lock in a rate and then shop. I do periodically see some lock and shop programs depending on the lender and different things. But so if you are out there looking for a home right now, this will give you some insight into which direction rates may be over the next couple of weeks / couple of months. But if you are currently in process, hopefully you've been talking with your mortgage professional to make a decision on whether it was a good time for you to lock in. The last few days, I've been advising to lock in ahead of this meeting. I don't think this meeting is going to be good for mortgage rates, because I believe that markets are basically like a whiny, pouty, petulant 4-year-old. And let's kind of back up. So when you look at traders, and when I talk about the markets, a lot of times when we say markets, I mean stock markets along with the bond market. Traders are there to make money. So it's basically what they're there to do. They want to make money. And in order to make money, they want businesses to be profitable and businesses to make even more profit and for stocks to go up in value. And what we've seen happen with the Fed raising rates over the last year to crush inflation has definitely affected stock markets. We've seen stocks go down tremendously. And, traders are basically, like I said, they're like a petulant, whiny 4-year-old now, where they're insisting that they want the markets to improve. They want more profit. They don't like this anymore. They don't like the Fed raising rates. They want to see this stop. And in January, markets were ignoring the Fed like a 4-year-old might. And the Fed said, like we're going to call him Daddy Powell. So Fed Chair Jerome Powell, he's the dad. And Dad Powell says, hey, we're going to raise these rates until we are sure that inflation is going down and going down significantly. And you may not like what happens when we do this, but hey, we're here to raise rates, and acting like a good parent, maybe it's doing something we don't like for our own benefit. And markets, acting like a 4-year-old will, just kind of didn't listen at all. They were like, la, 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 la. And they basically said, no, the Fed's not going to be able to raise those rates because, the inflation's already slowing down and the economy is slowing down. And, basically it was more of a want than an observation. They want the Fed to pause on rate hikes. So then February hit, and we got that labor data that showed that the labor market is doing very well. We've got more economic data showing the economy continuing to do well and not losing ground. So then it was those 4-year-old traders said, okay, maybe Daddy Powell is right. Maybe the Fed is going to raise rates more. And, they kind of cried about it and got mad about it. And then March hit. And in March, just a couple of weeks ago, we had banking failures. And I put the air quotes on that because when you talk about a banking failure, there was one bank in particular, Silicon Valley Bank. And when we look at it, it was compared to what happened in 2008. Now, I was a mortgage guy in 2008 writing loans. Carlos, were you in the business back then?
I was doing, what the heck was it? Notary stuff back then. So I was in the business. So I've kind of weird background because I was doing the business 25 years ago and then left the business and got back in at 17. But around the time of the crash, I was doing basically notary stuff. And so it was weird because I went from doing refi notary, like doing refis. And I knew just enough to be dangerous because I would go do these closings. And as a closer, I couldn't actually tell them they're getting ripped off. But I'd look at the paperwork going, oh my God, this deal sucks, and I'm just kind of, here you go. And then if they had any questions, I'm like, talk to your loan officer, not me. Because, as the closer, you have no authority over any advice. My job there is to collect signatures and stamp deals, and it was kind of, and there were some deals. I mean, there's literally old ladies crying and going, I don't know if I should do this. I'm like, I don't know. Call your loan officer. You have 3-day right to cancel. Yeah. It was crazy. When the crash hit, I mean, it was crazy because then all of a sudden it went from that to doing cash deals. All of a sudden, real estate officer could be calling me and be like, hey, we got this cash deal. Come to this office and stamp some papers. I'm like, okay.
Right.
So that was what I was doing. And people would come to my house doing what were they? Those oh, what the hell is it called? Where it wasn't a refi, but they renegotiate the deal and they come and sign
renegotiation.
renegotiations. Yeah, so they would come and sign those, and it was a
loan modifications.
Loan mods. Thank you. That was the word I was thinking of. So I did loan mods for a few years.
Yep. So where I was going with that is, as a mortgage guy, we would wake up ready to fund a deal and find out the lender, the banks, had gone out of business overnight. That was a true banking crisis. And what happened with Silicon Valley Bank had nothing to do with that. In fact, it wasn't a credit policy error. It was basically an asset situation. And I don't want to spend a lot of time talking about it, but bottom line, I don't think that the Fed is going to be too shaken up by a handful of banks and what we've seen happen recently. The ones that get the most headlines, of course, was Silicon Valley Bank and Signature Bank. And then overseas in Switzerland, we had the Credit Suisse, which is a very, very, very large bank, equivalent to our Bank of Americas and Wells Fargo's and Chase's, these very large banks. That bank had problems, but that is outside of US regulation and not protected with the same regulation that banks here in the United States are protected since 2008, with all of the regulation that's been put in place to protect our banking system. And
so you think they'll just keep raising rates on
I
and
do.
on and
I
on
do. I
forever?
think, not forever. No, not at all. But I think they're going to.
They got to stop though, don't they?
Oh, absolutely. They're definitely going to have to stop. But I don't think they're going to stop now. Well, and that's a great question. So mortgage rates, if y'all remember, mortgage rates go up now in reaction to what we think the Fed is going to do months from now, right? Because markets are trying to get ahead of it. So right now, if you would look back in February when we seen mortgage rates push back up, we went from having VA rates in the mid fives and the low fives to up into the, a point higher into the sixes. The reason that we saw that was because mortgage rates were reacting to the idea that the Fed was going to raise their policy rate in March, in May, in June, in July even, and that they were going to push their Fed funds rate up to 5.5, talk of 5.75, maybe even 6% for this Fed funds rate. And instead, now, if I go ahead, I'm going to bring it up on the screen and share with you. I've shared this with you many, many times. These are Fed futures. And basically, this is what markets are trading, what they expect rates to be. And right now, if we look this morning, and let's refresh this page just to make sure we've got the most updated information. If we look at this meeting today, the expectations are that the Fed is going to go ahead and raise rates. There's an 86% expectation that the Fed will raise rates today. There's a very small amount out there that believe that the Fed will have to pause today. Now, there's a couple.
What's going to happen? So if they pause, I guess. What do you think you're having mortgage rates depending on what if they raise a half point, do rates go up? And if they if they were to pause today, that would put a huge red flag out there that they were concerned about the banking system. If they did pause today, we would see mortgage rates improve probably by 0.25% by the end of the day. We would see a big jump, or at least by tomorrow. We would see a big move if they were to not raise. But the expectation is that they're going to raise by 0.25%. And if we see that happen, it's going to fall down to what markets think is going to happen in the future at the May meeting, the June meeting, July meeting, the September meeting, the November and December meetings. And the way that we're going to find out what the markets believe about that is that today the Fed is going to release a statement at 2 p.m. and they're going to release their policy, their rate and policy statement. So the rate statement will say if they're leaving rates the same, cutting rates, or increasing rates. The expectation is they're going to increase rates to 4.75. That's 0.25% higher for that Fed funds rate than where we're at today. You'll see that trickle into credit card rates and title rates and a car loan rates. That's going to bring those rates higher. Mortgage rates have already priced this in. We would expect to see this move. That in and of itself isn't going to hurt mortgage rates. But the next thing that's going to happen is we're going to get what's called the dot plot. The dot plot is the different Fed members, and there's, I think there's like 15 or 18 of them, and they're going to go on and anonymously, they're going to plot out where they think rates are based on each quarter between
now in the next couple of years. And depending on what markets think, markets are currently pricing in the idea that the Fed is going to raise rates up to about 5% now. And again, at the beginning of March, the expectation was we would see this go up to 5.75, maybe even 6%. So that's a full percentage point lower than expected. And they're also calling for rates to actually come down, for the Fed to start to cut rates by the middle of the year, by July. That would bring us back to this 4.75 in September. They're thinking maybe 4.5 at the November meeting, at 4.5, possibly even 4.25. And then by December, that rates would be down, to about 4.25. So that's what markets are currently expecting. Like I said, markets are like the petulant 4-year-old. They are pouty. This is what they want to see. And if the Fed acts like a good parent and says, hey, that's what you want, but that's not what's going to happen. We're going to need to raise rates because we feel that the banking system is fine. And we've got a couple of things in place to protect against other banks failing, which the Fed has put in place. They've got a different Fed window. Again, I could go real deep and explain to you guys about what they've done, but what matters is that they've done it. And the Fed is going to come out today, I think, and they're going to say, now listen, we are going to continue to raise rates, data dependent, based on inflation. And inflation is showing that it's come down from the highs, but it kind of stalled. It's not improving. And there's a lot of people that think the Fed needs to wait and see and let things catch up. But the Fed is very concerned about being caught in the same situation that we were about 20, 30 years ago, when the Fed chair Volcker had to then raise rates very, very significantly a second time very quickly, because what they did is they paused too early. Inflation took a big jump. And what happens is, if the markets get what they want, as a petulant child right now, they're throwing a temper tantrum. Well, if they get what they want and, Fed Chair Jerome Powell, daddy, hands them a big old lollipop, and now they're excited. Well, that's going to create a lot of positive growth in the stock markets, which people will love on their 401ks and their retirement plans and their investment accounts. But what that's also going to do is it's going to drive inflation. So we will see inflation to have gone down, and then we're going to see a jump in inflation. What does that mean? That means the Fed's going to have to step in and be even more aggressive. So the Fed does not want to let off the gas too quickly here. They want to keep it going down the road. So I think the Fed is going to raise rates again this month. I think they're going to raise rates again next month. I think mortgage rates are probably going to be pushed a little bit higher from here. And if the Fed gives a strong message today that says, hey, we're going to be aggressive with this. We think banking is fine. We think that inflation's a big problem. We're going to stick to the script. We are going to raise rates until we know that we have stamped out inflation. Well, markets are not going to like that. And they're going to throw an even bigger temper tantrum today. And that means mortgage rates will get worse today. And that's what you have to be prepared for. If you're under contract, if you're not locked in, you want to be talking to your mortgage professional about what could happen today and make sure that you're able to make that call in just a couple of hours. If you've already been locked in, then fantastic. You're avoiding that risk. Your rate has been guaranteed. You've taken action before all of this. If you're a professional watching this right now, you need to have a plan with your consumer today of what's going on, because we're going to have a 1-2 punch. And the first thing's going to happen at 2 p.m. and we're going to see a very strong initial reaction. And that could cause mortgage rates to actually change pricing right in the middle of the day. And then at 2:30, we're going to have that press conference. So at 2 p.m., we get the Fed policy and rate statement. We're going to get the dot plot, and we're going to see a lot of reaction. And then at 2:30, Fed Chair Jerome Powell is going to come out, and he's going to start taking questions. He's going to give an initial statement and then start taking questions. And we're likely to see another, big blow of activity when that happens. And it could be the opposite. We could see a negative initial reaction and then a positive reaction to his press conference. We could see a positive reaction and a negative reaction, or we could see a negative reaction to the initial 2 p.m. policy statement and dot plot, and then see things get absolutely worse and just snowball and see rates jump up by the end of the day another 0.25% if we get a negative reaction, if it's a 1-2 punch. And that's why, when we look at, hey, where are rates going to go and what is that rate forecast? Well, the forecast is kind of where we've got that happy guy here with his arms up saying, I don't know, because it's going to be very, very reactionary. And over the next few months, even if rates do go up, they're likely to come back down as we get closer to an economy that's slowing down, and you'll see talk of a recession, and longer term rates will improve again, as we've talked about. Once we see real signs of a coming recession, economic slowdown, labor market weakening, and falling inflation. This is the same forecast that I put out there last week. That hasn't changed. That's what I think is going to happen here. What do you think, Carlos?
Yeah, I mean, it is what it is. I mean, we just have to plot through this one day at a time. And it's interesting that, the housing market itself hasn't really slowed down much. It's funny. I call them YouTube economists. These people on YouTube that know nothing about real estate or mortgage that are constantly claiming they have the silver ball that claims that the market is going to crash. And then I will go and post a YouTube video with actual data and commentary. And then people are like, oh, you're wrong. Oh, okay. I'm wrong because how? Because I gave you data. I'm sure you saw that report last week that said housing's up like 15% in February, whatever it was, like huge jump.
Well, we've got, I was going to say so we've got existing home sales have increased. So that's a good sign.
Thank you. That's what
they were up 15%, which is good. But the big thing, the headline that came out is that, for the first time since 2012, I think it is, the housing has, the median home prices have dropped, but they dropped 0.2%. It was an insignificant, it was like from 363,400 to 363,000. I mean, it was but that could also be the first sign, and we may see a couple of months as time comes on where we may see that median home price drop a little bit as well.
And they're also saying the stats were manipulated. I don't know if you saw Barry's report. He basically said the stats were manipulated, though, that basically what they're saying is because more people were buying lower priced houses that wasn't really even a drop, which was the way he interpreted it.
That he interpreted. Yeah, I did not see that, but I mean, I could see where he's saying with a median home price, because for those that are, what I just caught from what you've said, Carlos, is there's more lower price homes selling. The higher end of the market has slowed down. So when you look at a median home price for home sales, the median home price is the price in the middle. And if these have slowed down, there's more of these, it's going to bring it a little farther down the scale. And it's very well the case, like you said. And I believe all this data is, 83% of statistics are made up on the spot. The other 17% are just manipulated. That's the old joke when it comes to any of this.
Yeah. I mean, it's sad, but true that, negative stats get more publicity. And I think that's why these YouTubers have realized that they can monetize their channel by just putting a bunch of negative BS out there. And then people like me that want to actually post real stuff, they're like, oh, you're just motivated by being in the industry. It's like, no, I'm in the industry and I know what the hell I'm talking about. So speaking of knowing what you're talking about, let's jump subjects a little bit, because we got the rate thing out of the way and we talked about that. So we do have a question. Let's see. It is, if I buy the points down, can I borrow more money? So let's first tell everybody what that means when they talk about buying the points down, and then can they borrow more money? And I'm going to let you handle this one, Carlos. Yeah, for sure. I mean, buying the points down would lower the payment, which would affect debt ratios, which in effect, they could potentially borrow more money. And if it's very, very close, that's certainly and you could even, use gift funds to buy those points down. So it's something to consider, and something I've used before when those ratios are close. That I'm like, okay, let's buy the rate down a couple points to make it work. So,
but what is buying down the rate with points?
So for those that may not be familiar with that, you got your par rate, which basically means you get your par rate and you get lender credit. So par rate is basically there's no buy down and there's no lender credit. So say today the par rate on a VA loan is 6%. I'm guessing, I don't have a rate sheet on me. So say it's 6, and you might be able to pay half a point and get 5.75 or whatever. And it kind of depends on the market and the rate sheet. And you pay a little bit extra closing, but then you have a lower monthly payment.
Right. So
and the opposite is a lender credit, where the lender gives you a credit and you would actually have a higher payment. And that's good if you want to get less cash to close, which I've done those too.
Right. So to kind of put it in perspective for everybody, a point is 1% of the loan amount. So that's what a point is. And if you pay towards your closing costs and you pay points, they can be called origination points or discount points, but they equate to the same thing. What they're going to do is you're paying upfront to bring the rate down. And I want you to think of mortgage rates being on a little bit of a sliding scale. So Carlos used the term a par rate. That's your middle. That's what the rate is when everyone says, what's your rate? And then from that rate, we've got a bit of a scale. Now we can move to one side. If the consumer, you can use seller credit or you could pay with your own funds. But if a consumer pays points, what they're doing is they're prepaying the interest and they're bringing the interest rate down. So instead of that 6% number that Carlos referenced, he said if you pay that half a point, which would be 0.5% of the loan amount. So if it was a $400,000 loan, you'd pay $2,000 and maybe your interest rate goes from 6% to 5.75. And because it's a lower interest rate, that brings the payment down. The payment may help you qualify to borrow more money because you have to be within a certain ratio. They look at what's called your debt to income ratio, meaning what is your income and what are your debts? And they're going to look at your housing debts as well as your debts with other expenses like car loans, credit cards, other kinds of loans on there. And based on that, the bank is going to say, this is what you qualify for. And it may be more than what you're comfortable spending, but that's what you qualify for. And that would allow you to then, we can figure out how much house you can afford based on that payment. And so if you don't pay lender credits, you can get what Carlos said was a rebate. So the lender can actually give you some money to help cover closing costs if you have them. And we can raise the interest rate. And that's called premium pricing. So we're charging you a little bit higher interest rate, but we're giving you money up front. And that can be used in some scenarios, can come in very handy if you need to pay down debt to qualify, or if you are looking to cover other closing costs. So the question for Guayaba is, if you pay points, can you borrow more money? The answer is yes, that may be the case, but it probably wouldn't be that much, I don't think. What do you think, Carlos?
Yeah, I mean, it depends. Everybody's scenario is unique, and that's one of those things that you have to look at it, and you also have to look at, how long are you gonna be in the house? Right now, paying down points isn't always a smart idea because you have to be in the house long enough to make that back. And right now, with rates expected to go down at some point in the next couple of years, most people just won't keep the loan long enough. Because one thing with paying points is they're not refundable. So if you pay a bunch of points now and then 3 years from now you refi, oh well, you paid that money up front. And so definitely, I tell people to caution on that. A lot of people are like, I'm going to pay all these points. They get all excited about that 4.75 rate. I was but you paid 10 grand at closing. That's crazy. Why not just take the higher rate and refi it later?
Yeah. So that's a great point on that is, and just to clarify for consumers that are watching, if you do pay points, you want to figure out what is your break even point. And it's just a math problem. So basically you just take a look and say, okay, well, if I'm saving, let's call it, just for a round number, $100 a month, but it's going to cost me $4,000 in points. Well, that's going to be 40 months. 40 months at $100 is $4,000. So I won't recover my money. I won't break even for 40 months in. That's 3.5 years. And I won't be to the good where it had made sense to pay those points for the time past that. And we do think that rates will come down significantly enough from here where a lot of our veterans will be refinancing. And again, one of the things that you have available to you as a veteran is access to the IRRL, which is the interest rate rapid refinance loan. And there are some parameters that have to be met in order, some guidelines that have to be met to qualify for that. You have to make 6 monthly payments. You have to wait at least 210 days, but you have to save, I think it's at least a half a point, right, Carlos, on their interest rate?
Yeah, half point. And there's a 3-month recoupment period, which basically means they have to make back the fees within 3 years.
Yeah.
36 months recoupment period, which I think that's a good idea on any refi. And I started kind of putting that in my own guidelines on any refi because it's just a smart thing when you're refining. If you can't get the money back within 3 years, why refi? It makes no sense to me. So pretty much any refi, even if it's not required, I do that. So,
yep. So, all right, y'all. Well, we are definitely a little bit long today, so If you have any questions, ask them. If I'll keep an eye on in the meantime here. If you do have any questions, we'll answer before we wrap up today. Otherwise, thank you for joining us. Definitely see what today brings as far as the afternoon. Join us next week. We'll be talking about what did happen today and where rates are a week from now. And again, this is going to be one of those situations that we're forced to react to what's going to happen rather than being able to give you a clear forecast on what's going to happen. Carlos, anything that you want to leave everybody with before we wrap up for the day?
I think that's good. Just watch the news and pay attention, and we'll see what happens.
All right. So please join us next week. Remember, 12 p.m. Eastern, 11 a.m. Central, 10 a.m. Mountain, 9 a.m. Pacific. If you're in Arizona, well, then you're Pacific to us. So otherwise, you guys have a fantastic week, and we'll see you next week. Bye-bye.
See you later.